Here's a number for you, 528,000. We were looking for 250k. That's what we call a monster upside surprise. That means futures are down. They're lower by 1% on the S&P 500, on the Nasdaq down by 1.6%, and I hate it. I hate it when good news is so-called bad news. And here's the why. Switch up the board and get to the bond market. There's your opening bout for equities. Yields higher, aggressively so, by 13 basis points to 282 on a 10-year, much more so on a 2-year, up by around about 20 basis points on a 2-year yield this morning. Just unbelievable. In the FX market, yields up, dollar stronger, euro down. Euro dollar down to 101.55, negative 0.9%. And crude, get used to not sub 100, sub 90 apparently. $87 and about 15 cents. We're down by 1.6%. That's the cross-asset price action. About 30 seconds into this one. Let's get you some movers. Here's Abby.
John, well, sticking with that good news is bad news macro theme, it's all about big tech weighing on the markets today because, of course, as yields surge higher on that monster jobs report, that pressures big tech valuation. Apple down 1.3%, Microsoft down 1.1%, NVIDIA, the chip maker, the chip giant, down 1.8%. So we have some real weakness for this tech sector. We also, interestingly, have weakness for the banks, the financials, not in a huge way. Bank of America down 0.3%. This, of course, as yields surge, but the yield curve, as you've been mentioning, inverted by more than 40 basis points at 210, the most since August of 2000, John, and it's hard to not remember that bear market then where there were lots of rallies and then drop, rally, drop over a long period of time. It almost feels that way again. But today, of course, we do have some weakness on that monster jobs report.
Abby, thank you. Ian Shepherdson of Pantheon Macroeconomics out on Twitter right now. How's that recession call going? I'd say not well this morning. Equities are down about 1% on the S&P. On the Nasdaq, we're down by 1.2. Big tech under pressure. Taking a look at that. Here's Taylor Riggs.
And John, the numbers, of course, through yesterday's close, when you think about sort of the big rally that has been underway from the low that we had June 16 up until now, up more than 19%. We'll, of course, subtract a point from that this morning when you think about sort of the big rebound that we had. Okay, 17.8%. So not sort of quite out of that bear rally, but sort of clawing our way out of that. When you take a look at maybe some of the individual sectors, or if we go sort of out of sort of the NASDAQ, you can see ARC, of course, had been up through yesterday, 37%. Stocks index, of course, biotech had already sort of climbed its way out from the big lows, up more than 20%. As you know, though, it always comes down to not only the big jobs report today, the CPI next Wednesday, and the pivot from the Federal Reserve, or maybe no more pivot. If we're thinking, are we still dovish? Are we now going to be hiking 75, maybe 100? It all comes down to the earnings outlook, and that's what we're looking at as well here. When you think about big tech, the rate story is, you know, sort of the input into that discount cash flow model is all about rates, and of course looking out for a bottoming out of some of the earnings revisions, lowers as well, to signal out a bottoming of this market.
Taylor Riggs, thank you. The Fed has more work to do, and that means maybe we've got some more wood to chop on the Nasdaq. We're down about 1.4% on the Nasdaq right now. Bank of America publishing moments ago, we now look for the Fed to lift the target range of the Fed funds rate to 350 to 375 by year end, and you'll hear the 4 a lot more going into CPI next week, and we'll see whatever CPI is. Right now then, down 9 tenths on the S&P, on the Nasdaq down by about 1.26%. We reverse the recovery rally with yields absolutely surging. Good news turning into bad news for markets. A monster upside payroll surprise, fueling bets for another big rate hike. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, that's reflected in the cross-asset price action. Not just stocks down, but the dollar stronger on the day. And as you said, Treasury yields are absolutely flying, more so on the short end, which of course is the pricing of more aggressive Federal Reserve rate hiking. The 2-year yield right now on the day up 18 basis points to just shy of 323. And of course, that puts it even more ahead of the 10-year yield. Right now, that curve inverted by more than 40 basis points. That is the deepest inversion going back 22 years to August of 2020. And usually that is an indicator of a recession, though as you've alluded to, this doesn't look all too recessionary at the moment, as the market is pricing in a greater odds of a 75 basis point hike next month, John.
Kaylee Lyons, thank you. Thank you very much. Just breaking down some of the data and what this all means for the Fed. I'll break you down on what's going on in this market right now. About 4 minutes into this session, equities are lower by about 0.8% on the S&P 500. On the Nasdaq right now, we are down by about 1.15%. I'll give you the sector breakdown as well on the S&P 500. You can work out where things might be going given what's happening with yields now, up by about 20 basis points on a 2-year. Information technology down by 1.2%. I want to run you through the bond market as well. 2s, 10s and 30s shaping up as follows. On a 2-year yield, up by 19 basis points on a 2-year to about 323. On a 10-year at the moment, yields higher by 13 basis points. So the heavy lifting happening at the front end of the curve. That means the curve inversion, 2s versus 10s. Now negative 40 basis points. And Tom Keene and myself a little bit early this morning said the same thing. A shout out to Priya Misra of TD, who was looking for this. Just a monster call from her. She said negative 40 basis points on 2s, 10s. Right now this morning on 2s, 10s, we have negative 40 basis points. On Bloomberg TV and radio, I'm pleased to say that joining us now is Labour Secretary Marty Walsh off the back of this stellar jobs report. Secretary Walsh, the floor is yours, sir. Your thoughts on this one?
No, thank you very much. This certainly is a great jobs report. When you look at the different sectors, most of the economy is recovered. The jobs that companies had pre-pandemic are all returned, so it shows good gains. We've showed some good wage growth. We've shown good areas. Manufacturing is one of those areas that certainly we've seen come back, not just come back to pre-pandemic levels, but go beyond that. I think with the CHIPS bill that was passed and signed, it's going to be signed into law next week, we can do more manufacturing in the United States of America, which in the long term will help us with some of the inflationary pressures such as semiconductors and more microchips.
Secretary Walsh, what a turnaround this has been since the pandemic. Can we just take a moment to think about that, how much we've recovered over the last couple of years? And can you talk to me about how sustainable you think these jobs gains might be?
Well, I'll tell you, pandemic, March of 2020, I was the mayor of Boston, and we were shutting businesses down. We were shutting restaurants down. We didn't really know what the economy held, and thinking about where we are today was really incredible. And I think that this will, in my opinion, will be sustainable moving forward. I think companies are understanding. I think we're going to have a new type of economy. I think we're still obviously dealing with inflationary pressures. You talked about it right before we got on the air here. I heard you talking, and I think that, you know, we're going to adapt and adjust, and we're going to move forward. I think that the infrastructure law that was signed into law, we're going to see more investments all across America on roads and bridges. I think with the CHIPS bill that was passed and move forward, we're going to see more investment in manufacturing. Hopefully the bill that's being worked on now in front of the Senate is going to be working on prescription drug costs and environmental climate change and some other areas is going to help. When you really think about a lot of what's happened here under the Biden administration is something that we've talked about for the last decade or so, and these are all going to be good bills and good investments to move our economy and quite honestly move America forward.
I know you've got a lot of people to talk to this morning. I did want to talk to you about the negotiations on the West Coast with the ports. This
I was going to bring it up.
I know you are, because this was your quote last time we spoke. You said, next month if I come on this show, if we don't have a contract and we're not close to a contract, then you and I might be having a very different conversation. So I guess, do we have one? Are we close to one? Or are we having a very different conversations?
No, I don't know how close we are to getting a contract, but one thing that has happened since we've spoken and both sides have agreed is the health care, and that was a big sticking point. That's usually a big sticking point, the costs around health care and who's going to pay for health care, and that was negotiated and solved about 10 days ago. So I'm very pleased with that. Now they're on to the next phase of negotiation, and usually when you think about contracts and negotiation, the biggest sticking point is around health care, pensions, things like that, and those are in the rearview mirror now. Now they're moving forward on some of the other issues they want to tackle. So I feel good where we are. If I said that, I probably should have used my words a little better if we don't have a contract by next month, but I am very confident where we are in the negotiation right now. I am not concerned. And I stay in very close contact with both the longshoremen union and the companies on the ports to offer any type of support we need, but every time I talk to them, they say we're moving forward.
Secretary Walsh, for some people who might not be that confident as you are, they might not be familiar with how this works, with this particular set of negotiations. As you said before, this particular one's a little bit different because it only starts 6 weeks before expiration. Can you help us understand things a little bit better by comparing it to 2014, where we were then at this stage and where we are now?
Well, I think we're further along than we were in 2014. If I remember, that took an awful long time to get done. But just for people that don't quite understand collective bargaining or negotiations, usually you can start months ahead of time to lay down the foundation for a contract. In this particular case, it's 6 weeks before the termination of the contract, which means it always runs over the expiration date. I don't think they've ever had a contract done on the expiration date itself. Normally, you want to shoot to get a contract by expiration date. But what both sides have agreed to do in this case have continued to agree to keep the current collective collective bargaining agreement in place while they negotiate moving forward. There's been no conversation of strikes, lockouts, slowdowns, none of that stuff. That hasn't even broached or brought up and talked about, and that's the thing that I don't think will happen in this negotiation. And I'm going to continue to talk to the sides, and where I need to put pressure on them. Certainly this is a big issue for the ports and for products coming into the United States of America, and quite honestly for exports out of the United States of America too. So we want to stay very close to that. Myself and General Lyons, who's the liaison at the White House, has been in constant communication. We talk a couple times a week, but we have a scheduled call just to go over where we are, just so we can stay on top of these negotiations.
Secretary Walsh, a monster jobs report is the final question from me for Boston. Do we need to see some labor turnover at the Red Sox?
Oh, God, I get myself in trouble there. I'm not really sure what's going on there, although they seem like they didn't make many changes, so they're going for something, so they must be going for that wild card spot.
That was from Mike McKee and Tom Keene. They were pushing me to ask Secretary Walsh. They had to go there. It's good to catch up with you, sir. Thank you. Labour Secretary Marty Walsh there on just a killer jobs report. I'll keep going through the price action. Mike McKee's going to drop by again and go through the labour market report after his 5th, 6th, 7th, 8th look at it. We'll get the view of Anastasia Amoroso and Mike Collins of PGIM and iCapital, respectively. We're coming off the lows here. On the Nasdaq, we're down about 0.8%. On the S&P, we're down 5 or 0.6%. In the bond market, just some big moves off the back of a big number. Up 18 basis points on a 2-year to 322. Coming up, investors looking ahead now to CPI data next week.
We're looking for another strong gain. So, the headline's going to be weaker just because you had that huge pullback in gasoline prices. But that shift from 1.3% to 0.2%, which is what we're looking for, it almost entirely stems from energy.
That conversation up next.
A few blocks to the Fed on the policy side, and they are not going to welcome this report. It's bad news for them in every single way. It makes the notion that we are neutral comical. It means that they're going to have to go even more. And the markets, you saw from what happened to the inversion of the two stands, it's now beyond 40 basis points, is saying that they're going to have to somehow break this economy to bring inflation under control.
That was Mohamed El-Erian earlier this hour. The US payrolls report coming in hot with a host of data still coming next week. The main event, CPI on Wednesday. Mike McKee back with us for more. Hey, Mike.
Hey, John. We have a very strong report that takes care of the mandate for the Fed to bring down unemployment. We come in with 528,000 jobs for the month and an unemployment rate of 3.5%. That matches the low in January 2020. Pre-pandemic, average hourly earnings unchanged at 5.7%, and of course now we're 32,000 jobs above where we were when the pandemic started. So all good news for the president and for workers, whether Mohammed's right about the Fed. We'll find out next week when we get the inflation numbers. Next week is all about inflation in the economic data. CPI on Wednesday, PPI on Thursday, Friday import prices, and it's going to be interesting now to see what happens with this Michigan number, whether sentiment overall improves because of this, and whether people think it means, along with the gas prices coming down, that inflation is going to come down, and the Fed has a little bit less to worry about in terms of inflation expectations.
Still reacting to this one, Mike, this 528. Just a final word, Mike. I asked this question earlier. Does that pass the smell test from your standpoint?
I don't have any reason to think it doesn't. There isn't a seasonal factor in the July numbers that should really worry us, but it is odd. It's hard to explain other than companies just hired. You'd think more people went into the labor force, and so they were able to fill some of those job openings, but the labor force shrank. So I don't, at the moment, have a good explanation, but fortunately there are people smarter than me who will figure it out.
I'm sure they'll figure it out in the next few hours. Mike McKee, thank you. It's a fantastic number, that's for sure. The president taking a victory lap of sorts, saying it's the result of my economic plan to build the economy from the bottom up and the middle out. It's a favorite line of his. I ran for president to rebuild the middle class. There's more work to do, but today's jobs report shows we are making significant progress for working families. 528,000. PGIM's Mike Collins, iCapital's Anastasia Amoroso, they join us. Anastasia, you've had a bit more time to digest some of this. Your thoughts on this one?
Well, John, good morning. And I know you don't like the interpretation that good news is bad news, and I don't either. And I actually think that good news is good news here. And the labor market is still exceptionally strong. And that means that we can put some of the recessionary fears to rest. And that means the economy is still doing just fine. And the reason why that's good news is because I think there is a path to be had to soft landing here that the Fed so badly wants to engineer. So they're going to run the GDP growth below potential, but they're also going to bring down the job vacancies, but not necessarily the job creation itself. And that should not produce a big rise in the unemployment rate. That should be good news for the markets. I know that's not what we see on the screen right now, but the reason that should be good news for the markets is because if everyone is so worried about having to haircut the 2022 and 2023 earnings estimates, maybe we don't have to do that if we're not actually going to a recession. So my interpretation here is this is boomy, this is solid labor market, and the markets should over time welcome that. And by the way, it is too premature to think about what the Fed is going to do. We're still 2 CPI prints away from the next Fed meeting.
No, well said. It's a long road to September. Mike Collins, your thoughts, sir?
Yeah, Jonathan, I'm really in Anastasia's camp as well. I think people who think good news is bad news are kind of missing the big picture, right? If you just think about the different scenarios out there we've all been talking about, and I would ascribe almost before today, maybe a one-third probability to each of these scenarios. The first one is really Anastasia's, that you have just a soft landing, a moderation, GDP, 1 to 2%, inflation coming down. The other one is kind of a mild recession, which is the camp I've been in, where GDP averages maybe 0 for a year and a half. And then the third one is really the one everybody's worried about, the deep recession, which is mostly driven by stagflation, right? Higher prices and lower growth really forcing the Fed to push it and break the economy, as Mohammed said. But I think the probability of that stagflation scenario has dropped significantly, meaning risk assets don't have to reprice dramatically if you're in one of those other two scenarios.
Mike, 2s10s, -40. How much oxygen is left in that trade?
Yeah, that seems really, really deeply inverted, and I would take the other side of that, Jonathan. I think there's a good chance that the Fed doesn't go to 4 or 3 5/8 and then have to cut 100 basis points in the next 12 months, which is what's being priced in right now. I think there's actually a reasonable chance that they get that funds rate into the 3s, and maybe they're able to keep it there for a year or two. So, as Tom Keene would say, maybe that x-axis is getting pushed out a little bit. Maybe the funds rate stays kind of in that range. So I think you're supposed to fade this inversion a little bit here.
Anastasia, a lot of people have come out this week and said fade this equity market rally. You just said good news can be good news. Where in this equity market should it be good news?
Well, I think good news is that maybe we don't have to retest and break below 3,700 that we've seen before. And the reason I say that, if people start to have some confidence that $240 on the S&P 500 next 12-month earnings estimates can hold, then maybe you apply a slightly lower multiple to that. But at least you don't have to haircut that into the 220s that everybody feared. And so the good news is that, maybe, we give a little bit back here. We fade some of this monster rally that we have had, but we may not necessarily have to worry about another, 20% down from these current levels. So, don't get me wrong. I do think this market continues to be range bound because we've got fears about hot inflation on the one hand, and we've got fears of imminent recession on the other hand. So this market is sort of trapped here, but I think we kind of know what the trap now looks like. It's between 3,700 and probably 4,200 on the S&P 500. So it would be nice to break above this range, but we're probably not going to do that in the meantime. So I would focus on getting paid while you wait out this volatility. I would focus on buying equities if we do get down to that $3,700 level, but that's really the playbook for now.
Bank of America is exactly with you, almost exactly the same numbers, almost precisely. They're looking for a range of 38 to 4,200 until the next Fed decision in late September. And as Anastasia said, the road to September is long, long, long. Mike Collins, we've had a ton of credit spread tightening, 140 basis points in about a month. Mike, does this jobs data validate some of that move or disrupt it because the Fed's got more work to do?
Yeah, I think last time I was on, when high yield spreads were approaching 600, I said we're kind of fully pricing in now that mild recession scenario, but not necessarily the deep recession. And now I think we're pricing in, kind of this maybe a higher probability, as Anastasia said, of this soft landing scenario where maybe, we say a positive GDP growth on average for the next year. And I think that's kind of what's priced in here. But similar to Anastasia's, range-based trade here, I think we're in the credit markets. I think you're going to be in this pretty wide range in high yield spreads, between 400 and 600, and you're earning a lot of carry, right? If default rates stay low and you're good at picking the credits, I think that's a lot of spread and a lot of yield in the credit markets, in the bond markets, and I think you're going to earn a lot of that yield for the next couple of years, so you have to be in the trade.
Mike Collins, what a moment. Anastasia Amoroso, happy to share it both with you. Just a massive upside surprise to the both of you, thank you. And a big move at the front end of the yield curve, up 18 basis points. The takeaway, universally, is that the Fed has got more work to do. That's the conclusion. Citi coming out just moments ago saying we continue to expect a 75 basis point rate hike in September and a march to 4% policy rates by the end of the year over at the Fed. That's the call from Andrew Hollenhorst over at Citigroup this morning. Coming up, the market moving events you need to be watching. That'll be next in our trading diary from New York. This is Bloomberg. 25 minutes into the session off the back of this one, still trying to process that number, just absolutely massive. Down about 5 or 6/10 of 1% on the S&P 500. The Nasdaq doing okay relative to the rally we've seen. We're down about 1.2% on the Nasdaq 100 in response to what's happening in the bond market. 2-year yields absolutely flying, up 19 basis points on a 2-year, on a 10-year up about 15. So 2s versus 10s, something like -40 through much of this morning. That's the price action. Here's the trading diary. You'll hear from the president, a happy president, I imagine, at 1 p.m. Eastern. And then we get the latest read on inflation with the US CPI next week on Wednesday. Ton of Fed speak from the likes of Evans and Kashkari, US PPI, and another round of jobless claims on Thursday. Then we round out the week again with University of Michigan Consumer Sentiment Survey. From New York, that does it for me. Have a wonderful weekend if I don't see you on Bloomberg Real Yield a little bit later. This was the Countdown to the Open.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Friday, August 5th. Here are the top market stories we are following for you at this hour. Oh my jobs. July payrolls absolutely crush expectations at 528,000 and wage growth heats up too. Is this the all clear for a more aggressive Fed? Sell it all. Yields soar, the curve inverts more deeply, and stocks plunge on the back of the report. Swaps price in another 75 basis point hike next month as more likely. So what about that recession? We'll get a read on real consumer demand through the lens of travel with Expedia CEO Peter Kern this hour. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, what a jobs report.
Yeah, we were kind of debating before the number hit the tape what kind of figure we could see. We were all way too low. And the fact that we're seeing wages doing what they're doing at the moment and participation doing what they're doing, this is not recession on, this is recession off, I think.
I think that's a fair characterization, and you are definitely seeing that reflected in the bond market today, Guy. The 2-year yield right now is up 17 basis points on the day, and as I said, the market now thinks it is actually more likely that the Fed moves another 75 basis points next month rather than 50. But of course, we've gotten the reaction from the White House as well to this blowout jobs number. Just moments ago, U.S. Labor Secretary Marty Walsh was on Bloomberg Television. Take a listen to his reaction.
Most of the economy has recovered. The jobs that were that companies had pre-pandemic are all returned, so it shows good gains. We've shown some good wage growth. We've shown good areas. Manufacturing is one of those areas that certainly we've seen come back, not just come back to pre-pandemic levels, but go beyond that.
So let's dive into the numbers with Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, blowing it out of the water in so many ways.
Absolutely. For the markets, it's a little bit like going to a restaurant and ordering something, and then a portion comes huge, and they're saying, are we supposed to eat all that? 528,000 jobs created. 250 was the forecast, so more than twice as many as anticipated, and much higher than the 398,000 we saw in the month of June. That, too, revised higher. June and May, a 28,000 job revision up. The unemployment rate falls to 3.5%. That matches the low in January of 2020 before the pandemic. Participation rate actually falls a little bit, kind of unusual. More people leaving the labor force to help compress the unemployment rate. Average hourly earnings unchanged at 5.2%, so that's good news for people who are getting jobs. The jobless story, as I mentioned, 3.5%, 6.7% unchanged in terms of the U6 rate. The discouraged workers rate did not go down, but the labor force did. 63,000, employment up by 179,000, and unemployment down by 242,000. That explains much of the change in the unemployment rate. And we just have to finish, Kaylee, by mentioning that the number of jobs has now exceeded the number in January of 2020 before the pandemic by 32,000. So we are now back to where we were when all of this started.
Yep, I think we're all a little bit confused. The data are all over the place, Mike, and this only further adds to that confusion. Mike McKee, on the numbers. Jay Powell, at his last press conference, was flagging the fact that the labor market needs to soften. So that brings us to our question of the day. Given the numbers we've just seen, is 75 basis points enough? We are seeing swaps taking us in that direction. Let's get an answer to that question. Tiffany Wilding, PIMCO's chief U.S. economist, joining us now for analysis. Tiffany, 75 enough?
Yeah, I mean, I think today's report certainly made 75 the base case. I think it's possible that Federal Reserve officials could start to talk about this 100 basis point rate hike, although I would suggest probably 75 is still the most likely here. You know, now what I will think will happen is the summary of economic projections that the Fed puts out in September. You know, they're not only going to do 75, but they're going to also, you know, sort of show or guide the markets through that there's more to come in the back half of this year. They need to do more. I think at a minimum, you know, you're going to see the median jump up to 3.8, which was where it was to 2023. So they're going to basically front load or pull forward rate hikes even more than they already have.
Well, so Tiffany, to that point, is this changing the pace of hikes or the ultimate destination?
Yeah, so I think that's a really good question. You know, I think we would argue, at least right now, that it'll probably change the pace of rate hikes, and it's certainly possible that we could see a hike or two more that they pencil in for 2023. So maybe a little bit higher. You know, but of course the Federal Reserve wants to continue to assess and see data, and I do think the one thing that probably will give them pause is that we are getting very inconsistent signals depending on what data you look at. So if you look at a broad broader range of labor market indicators, and obviously the things in the GDP report or spending indicators, they do suggest that the economy is slowing. So it's a little bit puzzling that none of that is showing up in the labor market report, at least in the establishment survey. But Federal Reserve officials will be, I think, cautious at least that some of that could show up, in the months and quarters ahead.
So, Tiffany, how high do you think we ultimately end up going with the Fed, and how long do we stay there?
Yeah, I mean, I think that is really the key question, obviously, for markets. And it's one that's obviously highly uncertain, and it's something that the Federal Reserve is going to have to continue to assess as they hike. And what makes this more difficult is that monetary policy works through long and variable lags. So, the hiking that they've done so far, that, isn't fully going to be reflected in economic outcomes, for at least some time to come. We're starting to see, the housing market and some other interest rate sensitive sectors of the economy like autos, et cetera, start to slow down. But we really haven't felt the brunt of that. So the Federal Reserve is probably going to get to a place, they've said moderately restrictive, where they think they need to be, see how much the economy is slowing down, and then assess if they need to move higher, kind of stay there or move lower. So I think this is going to be, kind of like a guess and check. It's difficult monetary policy in practice, certainly more than an art than a science. So now I think this is very uncertain. But I do think, though, again, the end of the year, having them forecast they get to kind of a 3.8 level, to us, I think makes sense.
Yeah, to your point, Tiffany, on the lag, clearly, if they're trying to get demand down in the labor market, we are not seeing evidence of that yet. But it begs the question, what they want to see is the number of available jobs in the economy coming down and inflation pressures, therefore, coming down as well. What level of unemployment do you ultimately think that will take? How far above it is 3.5%?
Yeah, I mean, so there's this whole discussion right now about, because the number of job openings is so elevated, and we just haven't had people, been able to fill them. There are frictions in the labor market as a result of the pandemic, people moving out of city centers. You have this migration happening, people moving to different sectors, reallocation. All of this is creating friction in the labor market. And that's resulted in higher openings relative to a given unemployment rate. So the question that Federal Reserve officials are trying to understand, is that can we just bring down the level of openings for jobs without really getting, without having people, laid off or getting fired? I think that is going, history would suggest that's going to be difficult. You do tend to get labor market weakening and the unemployment rate ticking up when you have growth slowing. So not to mention if there's a recession, right? So, ultimately, I think the unemployment rate does tick up over the next year or so. And certainly it'll be a question on how much, and we'll have to continue to watch and monitor the data to get a better sense of that.
Upside surprise today. What happens, Tiffany, if we get an upside surprise next week on CPI? The number's expected to go 9.1 to 8.7. If that number comes in hot, how does that change the calculation?
Yeah, I mean, I think that it ultimately confirms, that inflationary pressures, it's just one more data point confirming that inflationary pressures are broadening out. Obviously we saw that in the wages data that came out this morning. You're seeing that in a broad array of wage indicators that are being released. So, I think that's ultimately concerning. Obviously the details of any given report will matter, but what, is becoming more clear, I think, in the economic data is that although headline inflation could start to tick down because we've had some easing in energy and food prices, the kind of more core measures, they do look like they're going to be more more sticky at elevated levels. So I think that again will continue to be concerning for the Fed, although they are going to get some relief probably on the headline measure. Now, and just in terms of how this relates to a recession, I think the other important thing here is that although today's data confirm the U.S. economy is not in recession, it also confirmed that the Federal Reserve needs to do more to tighten financial conditions. So I don't think that it really changed the recession probabilities at kind of a 12 to 18 month time horizon, because the Fed just has to probably do more. But just engineering below target inflation might not be enough, right? You might actually have to get some contraction to bring inflation down.
Well, finally, Tiffany, this jobs report culminates a week packed with Fed speak in which they push back pretty aggressively on that whole pivot narrative. Are we seeing the return of guidance just after guidance was supposed to have died?
Yeah, well, I think ultimately, although Fed Chair Powell tried to get rid of guidance at the press conference at the July meeting, ultimately he provided guidance by pointing to the summary of economic projections. So he didn't actually, fully get rid of guidance. So I think that, overall Fed officials, they do need to try to, stop providing more concrete guidance. They have to start focusing on the data, and kind of give markets a sense for how they're going to react to some of the scenarios around their baseline outlook. So then the market can price in what it thinks the Fed is going to do on the Fed funds rate without them giving guidance. I think that's the best outcome. It looks like the Fed is sort of slowly moving in that direction, but we probably have more to do in terms of just fully getting rid of this, forward guidance.
All right, Tiffany Wilding, great to get your insight on the back of this monster jobs report. PIMCO chief U.S. economist, appreciate your time. And coming up, we'll talk about what the jobs report means for the equity markets. We'll take a look at that with the Bank of America Securities U.S. equity strategist Jill Carey Hall coming up next. This is Bloomberg.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
A very strong report.
It's surprisingly strong, and it's a reminder of just, how strong the economy is.
It's not only the strength of the labor market, but it is also the significant increase in wages.
The Fed, on the policy side, and they are not going to welcome this report. It's bad news for them in every single way.
They're not going to be able to pivot as aggressively as the market was expecting.
Certainly 75 basis points will be on the table.
They're going to have to go even more.
The narrative going in here from the FOMC was the Powell pivot, and this is the payroll pushback.
Those were some of our guests on Bloomberg Television reacting to today's blowout payrolls report, which brings us back to our question of the day. Is 75 basis points enough? Joining us now is Jill Carey Hall, Bank of America Securities U.S. equity strategist. Jill, is it, and how does that translate into an equity thesis?
Thanks for having me. Well, I think the market views of a dovish Fed pivot, recently, our view at B of A was that, may have been unfounded, and that we think that the market could have further to fall. The payrolls report today was obviously very strong, and as the prior guest suggested, suggests that the Fed needs to do more here to tighten financial conditions and to stem inflation. Obviously, very strong wage data. Our economist view leading into this has been that the Fed would hike 50 basis points and then followed by 2 more 25 basis point hikes at the subsequent meetings before pausing in 2023 and then ultimately cutting in the second half. I think that, inflation has been very, very strong, and in our view, even though we may not be in a recession yet, the potential for that is still high, and our economists are forecasting that we enter a recession, one that is mild by historical standards. So, the S&P 500, in our view, is not yet reached its bottom. Typically, when you look at other bull markets and the start of those bull markets, typically you see the Fed cutting before the market bottoms. So our view is that the S&P 500 ends the year at 3,600. The sort of worst case floor scenario in the event of a more severe recession, our bottom scenario could be around 3,000 to 3,200, but 3,600 is our base case target for year end.
Jill, why does the equity market in aggregate keep waiting for the Fed, and in particular Jay Powell, to sound more dovish? And why, when we get a tiny hint, maybe that's a mistake or not, we don't know yet, but a tiny hint that maybe that is happening, does the equity market overreact in the way that it has?
Well, I think, one of the things that's going on is obviously the inflation data has been so elevated, and, we are looking for inflation to begin to moderate from here. So when you look at the wage numbers this morning, when you look at broader inflationary measures, when you look at mentions of inflation on earnings calls, this has become at a level that it started to hit corporates and hit margins. We still think that consensus expectations for margins and earnings are too high. So we're expecting that S&P 500 earnings next year decline by 8% year over year. Consensus has still been expecting very positive earnings growth, a return to peak margins. So given the wage pressures, we think that seems very optimistic. And I think in terms of the macro data, there's still, the ISM came in better than expected, did deteriorate, but not yet in recessionary territory. Typically some of these macro indicators still may have further to fall. So we expect that there is, going to be a likelihood that we see a very volatile equity market for the remainder of the year, with potential for more downside risk. These bear market rallies, as we've seen, a very strong market the past month in July. These are common. We don't think it was necessarily the start of a new bull market yet.
Okay, Jill, so what in this environment we're talking about, when things are just generally slowing down, why prefer small caps?
So I think, given our view that there's more downside risk and more potential volatility in the market, we still see opportunity within equities at this point. So we think investors want to be focused on particular areas of the U.S. market. So we have still continued to prefer value over growth. We do prefer quality, high quality stocks with stable earnings. We do like dividend yield, which has been one of the strong factors or styles this year. And then we do think that small caps are better positioned than large caps. And usually small caps do underperform in downturns and recessions. But we think that, there are several things going on that I think are supportive fundamentally for small caps. Guidance this earnings season has held up well. Services spending has held up much better than goods spending, and that's where small caps are more exposed to services than goods. The opposite is true for large caps. CapEx has also held up, and small caps tend to benefit more from CapEx cycles in the U.S. So fundamentally, some supportive factors that we're watching. But from a performance perspective, and when you look at multiples and the equity risk premium, small caps have been discounting the recession risk a lot more adequately than large caps have. So we think they've actually been pricing it in more. And so if there's further downside to equities, it could actually be greater risk for large. Yep.
Okay, that clarification at the end I think is really important. Jill, when stocks bottom, How quickly will they come back? Investors have got very used to a V-shaped bounce back over the last few recessions that we've seen. Policies come back, it's supported equities, we've all come roaring back. Is that what we're going to see this time round?
Well, I think, you know, at this point, we're closely watching the data. You have seen equity sentiment deteriorate substantially, but when we look at our sell-side indicator, which is our measure of Wall Street's average equity sentiment, that still has further to fall before it gives us a buy signal on equities. When we look at, you know, the yield curve and the fact that, you know, earlier this year we saw an inverted yield curve, the flattening of the yield curve typically is a good long leading indicator on what volatility does. So we are expecting that the market is going to remain volatile, you know, not only this year, but potential volatility stays high for the next several years. So, you know, I think we still see more downside risk to the market, but we would really focus on opportunities, as I mentioned within it, you know, overweighting small caps, focusing on stocks that have dividend yield, which is especially important in a low return world.
I'm wondering if one of those downside risks is potential changes to tax policy. We saw a climate initiative out of Capitol Hill overnight with a proposed tax on share buybacks. What impact do you think that will have?
Yeah, we're certainly watching policy, and I think, you know, for share buybacks overall, we have been expecting that they're going to be lower than they were trending, you know, for many of the past several years. We are seeing an environment where dividends, we see a greater case for companies to actually raise dividends. Dividend payout ratios are very historically low, and this is a factor that tends to be rewarded in downturns. Companies that can actually, you know, pay healthy and stable dividends. You know, valuations for large cap equities aren't really cheap yet. Obviously, it makes more sense to buy back shares at cheap valuations. And companies are still, you know, overspending on buybacks as a proportion of their operating cash flow relative to history. So, you know, we do see potential that you know, use of cash can still shift, you know, as CapEx has become more important. And there's obviously, you know, even if there's a cyclical downtrend, which can impact CapEx spending decisions, there's still sort of a secular case as companies are reshoring U.S. manufacturing. A lot of companies have underinvested and really need to spend on CapEx. So we're not expecting a net benefit from buybacks to EPS growth that similar to what we would have seen in many of the pre-crisis, post-global financial crisis years.
Jill, great to get you on. Great analysis. Really enjoy reading the reports on a daily basis. Thank you very much indeed. Jill Carey-Hall, Bank of America Securities U.S. equity strategist. Greatly appreciate it. This is Bloomberg.
July's big jobs report was the eco number investors were waiting for. So what did the flow say about positioning heading into it? Bloomberg's Katie Greifeld is with us for today's ETF Friday. Katie?
Well, if you take a look at the flows, it seems like there was a lot of faith in this idea of a Fed pivot, the idea that the Fed was going to back off the pace of rate hikes. Take a look at the leaderboard. You can see small caps up there. That's IWM, VOO, IVV. Those are both S&P 500 tracking funds. You have TLT there, too, that tracks long-dated treasuries. Junk bonds as well, sort of just a real risk-on bid heading into today's number. And you do see the S&P 500 trying to go positive right here. So we'll see if these investors ultimately were right. But what's interesting is that if you look at Cathie Wood's ARK lineup, and I bring this up because she's joining ETF IQ on Monday at 1 p.m., you still see a lot of love for the ARK Innovation ETF. Of course, her flagship fund still sitting on net inflows of about $1.8 billion this year. That's even with a 47% drawdown. So still a lot of faith in this idea that maybe risk assets are going to rally into year end.
Katie, great stuff. Thank you very much indeed. Bloomberg's Katie Greifeld. And as she says, tune in on Monday. ARK Invest CEO Cathie Wood joining the ETF IQ team. As Katie says, 1 p.m. Make sure you tune in for that on Monday. What have we got coming up on this show? There's only one subject really that is worth discussing. More on those blowout jobs numbers. Luke Hickmore from Aberdeen is going to be joining us. This is Bloomberg.
We are an hour into the U.S. trading session, and not just any trading session, the Friday session after a monster U.S. jobs report. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, the reaction, sell bonds and sell stocks, but that might be changing.
Yes, this, Kaylee, is what they call a round trip. Take a look at this chart, this intraday chart of the S&P 500 E-mini future. So into that jobs report, you see the E-mini futures not really doing all that much. On that jobs report, an absolute plunge. That, of course, the idea that good news is bad news because it did push yields up so much, which then brings into question valuation on stocks. But investors have reconsidered, and now we see stocks basically off of those lows, down ever so slightly. Who knows how the day is going to end up? Certainly an interesting day so far. Relative to some of the more outsized movers, not so much influencing the macro picture, but worth taking a look at. iRobot up 19%. Amazon is buying for $1.7 billion or $61 per share. The stock is close to it, suggesting the deal will get done. DraftKings, a very good quarter, up 16%. They also raised the view. Warner Brothers, on the other hand, not so great. Wells Fargo actually downgraded shares. And then Virgin Galactic down 14.5%. This is their commercial flights to space have been delayed again, so some are concerned about the cash. That, of course, has been the short story. There is a 26% short interest on the shares of Virgin Galactic, so that is the story. As for yields, bonds, let's take a look at what's going on here. This is really pretty interesting. So, of course, on this monster jobs report, the idea that the economy is super hot, we now have a very strong likelihood that the Fed or markets, investors, pricing in the likelihood that in September, the rate hike will be 75 basis points. That would be the third in a row. I believe 2 was the most on record, so this will really be a historic moment. If that happens, there are, of course, 2 CPI prints between now and then. And then finally, it's hard not to notice the huge surge in yields, but of course, it's really happening at the short end more so than the long end. That means that we're looking at the most inverted 210 yield curve going all the way back to 2000, August 2000, 22 years ago, right around 40 basis points. And Guy, as you know, historically, 9 to 12 to 18, 24 months after this sort of inversion, a recession comes. But after this jobs report today, a lot of people are walking back their recession calls.
Yeah, Tiffany Wilding from PIMCO a little bit earlier on saying that timeline probably still does apply, but the journey to get there is going to become a little bit more interesting. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle and what's happening with these markets. Surprising to see what equities are doing right now. The bond market, obviously a huge focus in all of this. Joining us now, Luke Higmore, Aberdeen Investment Management, to give us a take on what is happening here. He's an investment director there. Luke, great to catch up. What do you make of the market response to the numbers we saw today, which were incredibly strong?
I think the market's confused. On one hand, we've got, as you've been talking about, this whole, it's a big number, that's inflation, that's 75 basis points from the Fed. On the other hand, is there really a recession? Look, recession is coming. The consumer is hurting. We've seen Zentner at Morgan Stanley's report in the last month saying, the lower income quartiles of consumer have blown through their savings. It's starting to work into the middle income quartiles as well. It is coming. The fact we get a blowout jobs report, I think, is a massive distraction for the market. And it probably does tell us the Fed's going to move. But equities should not be getting excited about this.
Okay, so Luke, if you say a recession is coming, is that also saying that the Fed isn't ultimately going to get to as high of a terminal rate, or do you think they hike through it?
I think they hike through the early stages, that really unusual situation of a recession and a Fed hike. Arguably, are we in one now? 2 quarters of recession, etc.? Maybe. Look, I think, like everything with the pandemic, it happens really quickly. The rate rises from the Fed are coming in at pace. The stable period where we get no rate changes will happen, but it will happen for 3 months. And then we're going to get rate cuts. So second half of next year, we're going to be talking about the speed the Fed are rowing back on their activity right now.
Okay, so Luke, when do equity markets discount that? Because everybody seems to have a hair trigger at the moment. They're waiting for the Fed pivot, and they're going to react very strongly to it. The last few downturns that we've seen stocks going down very sharply and then a V-shaped recovery back. Are you hinting at the fact that we could see that again?
Yeah, it makes sense to me. Look, high inflation means actually high nominal revenue growth for a lot of companies as well. The fact we may get, I mean, whether the Bank of England's right with a 2% recession next year, who knows? But let's go with their numbers, right? Let's say that happens in the US. That's still high single-digit revenue growth for companies. And I think once the market gets over the fact recession's going to happen, gets over the fact earnings, reported earnings could actually stay fairly stable through a recessionary period, I think we could get past it. So, do you know what, guys? That could be quite quick. We could be looking November, December, maybe January for the market to start thinking again. Maybe it's the classic January rally that we start looking for.
Interesting. Okay, and in the bond market, Luke, I'm looking at a 2-10 curve inverted by 40 basis points. How much further can that go?
Look, it doesn't often go over 40 on the negative side, the 2-10 curve. This is getting towards territory that is really clear a recession is going to happen. The market's priced in a lot of it. We're already seeing on the MIPR the peak of rates happening over the next year or maybe 2 years before it starts to come down again. I think 2s, 10s, who knows at the moment, the numbers are all over the place, but let's say in a 50 context at the bottom where we get to the 2s, 10s curve before that starts turning around. But I'll tell you one thing, that will turn around before the equity market turns around.
Luke, let's go to your wheelhouse, credit. I was listening to coverage earlier. Credit, in some people's book, now appears to be the place to hide out. You're starting to see some pretty juicy returns being delivered. The risk in the equity market is that we're going to see significant amounts of volatility. What do you expect to see in credit? And is that the place that you want to be hiding out right now?
It's almost too easy for me to say yes, isn't it? It's a credit investor. However, I think if you look, bank dividends, right? Let's start at a place where you should be really hurting through a recession. You should be getting big provisions coming in. Consumers are going to be hurting, and that should be hitting them. Actually, that may not happen. And yet, in the meantime, dividends in banks, 3-4% yield. Go out and buy AT1, 6, 7, 8, 9% for Credit Suisse with all their problems. That seems like a really sensible trade to me. And, if you look at credit yields versus equity yields right across the piece, they look more secure, they look more predictable, they're high at the moment because of what we've been through. I think that's a pretty decent place to be. Doesn't mean we're not going to get a little bit more pain on spreads.
Well, to that point, Luke, if I could just ask, I'm looking at high yield spreads right now, 441 basis points. That doesn't look to me like the recession you are talking about.
No, I agree. And US spreads in particular. I mostly invest in euro and sterling spreads where I think there's great value. US doesn't seem to have had nearly the same percentage corrections we've seen over in Europe. You could easily see some more coming there. But look, even that high yield spread in the 400s is fairly attractive, given we're going to see quite a low pickup in defaults. This is not a period where we're coming into high leverage, high capex, really pushing the envelope from companies. These are cautious periods for companies. We've just come out of COVID, for goodness sake. It's a cautious period. This is not go-go gadget time. So high yield, okay, but I think we can actually get better value in the bank paper.
All right, interesting stuff. Thank you for hopping on the phone with us, Luke Hickmore of Aberdeen Investment Management. Appreciate your time. Now, coming up, we'll talk about consumer demand for travel. They're shaking off 2 years of COVID-19 restrictions and taking trips again. That definitely showed up in Expedia's results. Revenue beating expectations. We'll have more with the CEO of the company, Peter Kern, next. This is Bloomberg. Well, we have to talk about the travel sector because we've had a slew of travel earnings this week. Airbnb, Booking, just to name a few. And the latest is Expedia, topping expectations in its results. Revenue coming in ahead of analyst estimates, suggesting a solid start to the busiest travel season. Joining us now is Expedia CEO and Vice Chairman Peter Kern with more. So, Peter, obviously your results show that demand has been resilient, at least through the second quarter. As you look forward, though, what does that demand picture look like?
Yeah, thanks, Kaylee, for having me. Let me say that right now, pacings for the rest of the year are running ahead of where we were in 2019. So there's still plenty of strength, and particular strength for the rest of the summer. I think the macro backdrop that you and Guy have been spending all morning talking about, obviously, something we all think about. But right now, travel seems to be the number one area people want to spend money on, recovering from when they were buying goods and other things during COVID. And that demand, continues pretty unabated. So we're looking forward to a strong rest of the year, but there are plenty of unknowns in the macro environment. So, we're just happy where we are right now.
Peter, as you say, lots of unknowns, but what is your gut telling you right now? Is this as good as it gets?
No, I don't think so, Guy. I mean, I don't know if it gets hotter, but it's pretty hot right now. And no global warming jokes there. But, the summer travel season has been particularly strong, the strongest, we've ever seen. And so I think that's going to continue for the summer. And I think it's hard to know in the back end of the year, but so far travel still is the top thing people want to spend money on. And I think that will continue for a while. Perhaps it'll be bumpy a little bit with the macro environment, but I think there's huge demand out there still.
Okay, so if people want to spend the money to travel, do you think we are, though, reaching the limits of what they are willing to spend, of the pricing power available to airlines and other companies in the travel sector?
Well, definitely prices are up a lot since 2019, but that's 3 years, and COVID, there was no spending, and now things are relatively less spending, and there's now tons of spending. I think as long as demand is relatively constrained, which we're still seeing in the air industry, in the car rental industry, and to a lesser extent in the lodging industry, people are, their prices will still be high. We'll see as if the industry can hold that, but it looks like that's going to sustain for a while.
Okay, just staying on that subject, Peter, I was digging through the labor market data a little bit earlier on. The wages for hotels and restaurant workers are annualizing at 9.4% at the moment. Is that sustainable? Is that something this industry can keep up with?
Well, I think the reason it's so high is because they've had trouble hiring, and they've had demand, and they've been hiring into that demand. And so if you look at the combination of pricing and what they're having to get the input costs at, I think it works right now. Obviously, if there's some macro pressure, you may see both things get softer, including, you may see prices come down, you may see the cost of labor come down. But right now, those things in concert are fine, essentially, and the hospitality industry is willing to hire at those rates, just like the airlines are willing to hire pilots for more, because the prices are sufficiently high that the numbers work and they can still get their margins. So I think that will continue as long as demand continues, but the labor market may get softer with the macro environment, and that should help the industry find more people at hopefully more affordable prices.
But of course, some segments of the hospitality sector don't necessarily have the same workforce. I'm thinking here of just alternative accommodations, people listing their own homes, for example. You obviously operate Vrbo, which is your alternative platform. How are you thinking about your market share position relative to competitors like Airbnb?
Yeah, so, we don't compete with Airbnb everywhere. We compete in the whole home business, and largely in resorts and sometimes in cities that have big leisure markets. And in those markets, we have had a really strong, several years. We are running ahead of, for a long time in share in our biggest markets, ahead of Airbnb and others. And we've been adding supply in those markets faster over the last year than they have. Now, they have huge advantages in places we don't compete, in the shared home space, in some countries where we aren't. So certainly, we don't compete with them everywhere. But in our areas of strength, we have seen a very robust market, and our marketplace has performed extremely well for our owners and for our renters. So it's been a great product. Been a great product during COVID. It's going to be a great product post-COVID, and that remains very strong through the summer and into the end of the year.
Peter, you've also been working on your B2B business pretty hard, and the numbers are really starting to show up. What was it, 100% plus growth that we've seen in this quarter? How far does that business go? What are your expectations there? What do you see in that segment of the market?
Yeah, so thank you, Guy. We're really ambitious about this space. I think that we, as you know, and we've talked about before, we've been rebuilding our technology stack so that not only we can serve our own customers better, but we can serve our partners better. And we're continuing to externalize more products. We're working with more partners with more products. And we think the addressable market is enormous. So we're highly focused on it. There's tons of opportunity in as simple things as, driving hotel or car rentals for an airline, let's say, but it goes into things like service, data science and machine learning, fraud capabilities, things we have at scale and technologies we have at scale that most travel players do not have. And ultimately, we want to power the biggest and the smallest players in the market. Think of an influencer who wants to sell travel, anybody who wants to be a travel entrepreneur. We want to have products to help drive those businesses, and we think that expands the base for our suppliers massively. So we're very excited about that business, and it will benefit from all the work we are doing on the consumer side. So it's a very symbiotic relationship there.
What kind of hiring are you doing, Peter? As you talk about investing in new technology, I'm just wondering what your workforce and the composition of it is going to look like in your view as you move forward.
Yeah, we've been hiring aggressively over the last several years through COVID, particularly focused on technology talent, design talent, product talent. Obviously, we have great commercial teams, but that's been an area of keen investment because we really want to change the game through our technology. What we are, in principle, is a technology provider to the travel industry, and we have the best technology. We want to advance that even further, and so we've been very aggressive in bringing great talent. We have a new CTO who joined us a year ago. We have lots of people around her who have been added, and a great team of people that we had already. So we're really advancing our cause there significantly. We're investing in that space, and we have been growing our technology capabilities and our ambition there. So we've been certainly spending money to grow that capability and bring in great people and add them to our team.
Peter, I just want to wrap this conversation up with some of what you've been saying. And some of what you've been saying is that we have a very hot market right now. It's gonna be bumpy. Yeah, the lights went out for a second. Glad to hear you're back. The economy feels strong right now. Your business, what you're doing right now, feels strong right now. Is this an economy you think needs slowing down?
Yeah, I mean, I think, look, the inflation numbers are pretty startling, and certainly we've seen it in travel, but we see it across food and staples, and you've had many guests talking about mortgage rates and other things. I think it would appear that the Fed is aggressively trying to slow it down and perhaps playing from behind right now. But yeah, I think I'm not an economist, but I think any Monday morning economist would tell you it looks too hot and it needs slowing down, and the Fed may have been a bit late, but I think ultimately they will get it under control. And I think the economies of the world, particularly North American economy, remain strong. So I think we are in for probably a bumpy ride as the Fed figures this out. But we feel pretty good about people wanting to spend on the things that really matter, like the things we do, as compared to maybe buying more vacuum cleaners or home appliances. So, we expect we'll be fine through that, even though it could be bumpy.
Yeah, we've got a lot of those kind of things right now. Maybe we don't need any more. Peter, great to catch up. Thank you very much indeed. Really appreciate it. Peter Kern, Expedia Group CEO and Vice Chair. Thank you very much indeed. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. U.S. health officials have declared monkeypox a public health emergency. That is a step that will free up funding, treatments and other services to fight the virus. The U.S. leads the world with known cases, more than 6,000 of them. And more fallout today from House Speaker Nancy Pelosi's visit to Taiwan. China has imposed unspecified sanctions on Pelosi and her family. Beijing also cut off talks with the U.S. on defense and drugs, and it continued its most provocative military drills in decades, sending warplanes and ships across the median line in the Taiwan Strait. Meanwhile, China's ambassador to the U.S. was summoned to the White House to receive an official protest. And Democrats have agreed on a revised version of their tax and climate bill. They will drop a provision that would have narrowed a tax break for carried interest. They also altered a minimum tax on corporations and added a new 1% tax on stock buybacks. A pivotal vote in the 50-50 Senate. Democrat Kristen Sinema says she'll back the revised plan. And another round of talks on the Iran nuclear deal are underway in Vienna. European Union diplomats tell Bloomberg that the divide between Iran and the US has grown wider since the last negotiations ended. They say the remaining hurdles could be resolved within 72 hours, but that would require high-level political decisions in both Tehran and Washington. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy?
Ritika, thank you very much indeed. Let's talk about where we are with the markets. We're coming into the end of the day here in Europe. Equity markets just rolling over a little bit. We were just beginning to push higher. That looks now, it's now starting to fade a little bit. We're still just about up on the week, actually, for the bulk of European equities. It's interesting. Banks and basic resources doing relatively well today. Media, I think that's WPP, coming under a little bit of pressure. In the next hour, we'll talk to an analyst about wire and plastic products and what is happening there. Stock 600 on the day, though, down by around 0.5%. We have certainly seen some equity weakness post the payroll number, unsurprising. But I think the bigger action is elsewhere. It's in the foreign exchange markets, which are exciting once again, and it's in what is happening, particularly at the front end of yield curves around the world. Euro dollar under pressure once again. We're at 101.65 right now. We're down by around 0.8%, but we are seeing broad dollar strength today. Is that going to continue, and is that going to continue to cause problems? So euro dollar 101.65. The UK 2-year, as you can see, significant sell-off there. We're up by around 11 basis points, 1.967. A kind of 1-2 punch, really. The spread between the economic picture in the United States versus what is happening in Europe feels absolutely galactic at the moment. You take a look at what we heard from the Bank of England yesterday. You compare it to the blowout payroll number we got today out of the United States. We're going to be talking about that next. In the next hour, coming up on the European close, Jeffrey Yu, Senior EMEA Market Strategist at Bank of New York Mellon. That conversation next. This is Bloomberg.